Hi, Ashwin.
Hello.
Good to see you again. It's 2022, and this is another of our Zoom videos to explain to our audience something new and insight from your expertise. And I'm so excited to be talking to you today, especially our topic today is on ETFs. Now, remember when I was with my banker and on your advice, I asked them to buy for me an ETF. And to my surprise, they'd never heard of it. And when I delved a bit deeper, they said, oh, no, let's not talk about that. I think it's too sophisticated a product for you. And I'm wondering whether that was a dent on me as a woman, or in general, talking about the Malaysian investor. Well, either way, it's not good news. So today I want to talk to you about ETFs. And I want to say that ETFs cannot be ignored anymore, because the ETF industry, let me read this, took in more than 900 billion new cash last year, easily surpassing the 500 billion record 2 years ago in 2020, and now holds 7 trillion in total assets. So please, can you tell us what it is?
Thank you very much, Jesse. Yes, I remember I was in KL about 2010, attending a meeting with you, one of the investment houses. And they were saying, I was telling them, please listen, ETF is going to be something very huge. It's going to become very big. At that time, the market has just started. And they said, it's too sophisticated, it's too complicated, we don't understand. I said, you don't have to understand anything. I'll explain to you what it is. But we couldn't capture their interest. And I was right. Again, I'm not boasting, but I was right. ETF has morphed into a huge industry now. Now, before I proceed and tell you what the meaty part is of this video, what is an ETF? Simply, an exchange-traded fund is a type of security that tracks an index or a sector or a commodity or any asset, but which can be purchased or sold on a stock exchange in the same way like a regular stock can be sold in whatever. So that's why it's called an exchange-traded fund. It's a fund.
It's like a basket of equities.
It's a basket of assets that can be bought or sold on an exchange. It means it's transparent. Okay. Now, ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. We can even buy crypto ETFs. Instead of buying physical crypto, you can buy crypto ETFs, and I'll tell you in a minute why. Okay, and we can even buy sector-based ETFs, and also ETFs that contain the stocks of specific countries. It's so interesting,
right?
Really. Okay. If you want to invest in specific sectors, technology, healthcare, all kinds of, there are ETFs for technology, healthcare, specific metals, industrials, and consumer sectors. So you can go into sector-based investments and zoom in on those investments, make money from them by investing in ETFs. Now, you can also buy ETFs on US stock indexes. ETFs, why we stress on this, ETFs? Number one, ETFs offer excellent diversification as a new way of making money or as a hedge to your existing portfolio. And secondly, the most attractive, the brokerage for ETF is only 0.3% per annum.
You see, I believe that if you buy a basket, it's almost as though your risk has been shared.
Diversified.
Amongst all those in that basket.
Yes.
So you spread out your risk, which is a good deal, yes. I feel.
It's excellent. It's an excellent hedging vehicle for those who are holding individual stocks. Now, this is something to know. It is an excellent hedging vehicle and risk diversification method for those who are holding individual stocks, because then your risk is hedged into different industries.
Exactly. So why would you buy an ETF as opposed to putting all that money into one particular asset?
I'll tell you why we want to do that. Because like I said, we can go into sectors. Instead of buying actual Bitcoin, which is so risky, it has dropped like 50,000 from the top. You can buy a Bitcoin ETF at a fraction of the risk of actual Bitcoin. You can buy Ethereum. You can buy Ethereum ETF at a fraction of the risk of the actual Ethereum coin. It's
Makes a
very
lot of
interesting.
sense.
Yes, it makes a lot of sense. Now, let me show you what's happening. As you know, the market has dropped. Okay, in January, as we predicted.
As you said, it always happens that way at the beginning of the year, that uncertainty as things begin to roll out.
Yes, and why I like markets to drop in January when the year just starts, because it also offers hedge funds a way to buy things on the cheap. Now, let me tell you the biggest joke.
Not just hedge funds, us too.
Yes. Now, let me tell you the biggest joke. It's not a joke. It's a very sad thing. I've always said this, and this is one of the reasons why we started our retail program. We have said that retail investors always lose money because it's not their fault, because they don't have financial intelligence of quality. Now, let me tell you what happened last Monday. I'm going to bring this better up. Last Monday, at 12 noon New York time, the mom and pop investors, the retail investors, the small man on the street, they cut loss on their stocks, 1.36 billion US dollars.
It's very discouraging.
Yes.
I'm sure you have a remedy.
Guess what happened after that? At 4 o'clock in the afternoon, or 3:30 in the afternoon, the hedge funds and the banks came in to buy, and the market went up. And that, on the chart point, that rise from the very low to midpoint was a significant watershed. It in a way signaled the bottoming out of this market. But you see, once again, like I'm saying, the retail investor was a casualty, right? The retail investor had to cut loss, and then the banks came in to buy it. I have been in the industry for 28 years. I've always seen this happen, and it's very disheartening.
I don't like to hear that. I need you to say something that puts us back on track, this retail investor.
I'm not putting retail investor down. Don't get me wrong.
Please tell us what to do.
It's very sad. It's very sad.
Come back on track.
So if you allow us to hold your hand, because I told all my retail clients, do not panic. On Monday, when they cut loss at 12 noon, we were buying more because we had the sure-fittedness, we had the quality financial intelligence that the retail investor on the street does not have.
Well, you can see what's going to come in the future, couldn't you?
Yes, of course. I said the market will drop in January. It's a major correction. Of course, as usual, the correction has overshot itself, which always is the case. You don't expect a correction to stop on the exact chart point. There will always be an overspill. But again, these are exciting times. Even if the market drops for another 1 month more, I think we are facing exciting times. Because, like I said, we know what to buy. We know. Now, let me
So the volatility is an opportunity to make money.
Yes, I always say in my videos, volatility leads to the creation of new wealth. Now, let me tell you how in the ETF market, the same thing happened this week.
Okay.
Over the last 5 trading sessions this week, 5 trading sessions, this whole entire week, there's been 13.5 billion US dollars of flows into equity ETFs, everyone. In this market drop this week, volatility, market dropping, there have been 13.5 billion of inflows into equity ETFs. See what's happening. But you see, the retail investors don't have this privy to this kind of information, and they panic.
Yeah.
This is my point. I am not looking down on retail investors.
What do we do, Ashwin?
Yeah.
What do we do?
What do we do?
Because most of us are fearful.
Yeah. So allow us for a fee to hold your hand, and I'll give you the details later. Allow us for a fee to hold your hand. I'm sorry, but we can't hold your hand for free. We're running a business.
So number one, don't panic. Number 2, look at it as an opportunity. Yes. Number 3, get professional guidance.
Basically, I don't want to be blunt here, but please pay for professional advice. Please pay for professional advice, and you will see the results that you want to see. Now, let me explain to you what happened this week. 2 ETFs have captured the bulk of the volume during this week's drop. One is the SPDR S&P 500 ETF. The ticker is called SPY, SPY. Take note of this. This is the largest ETF in the world. When you buy this ETF, the price movement mirrors that of the S&P 500 index. So if you think the S&P 500 index is going to go up after the correction, you should buy SPY. Okay, SPY is SPDR S&P 500 ETF. And the other ETF that garnered flows this week was the Invesco Triple Q Trust ETF. The ticker is QQQ. Take note of this. This ETF, Invesco Triple Q Trust, mirrors the NASDAQ index. So if you think the tech index is going to go up again, tech stocks are going to fly again after the correction, please go and buy Invesco Triple Q Trust.
And do you think they will fly again?
Of course, because like I said, NASDAQ is now at 13,005, 13,006, whatever it is. We still see at least 1,500 to 2,000 point pickup this year.
Okay.
We at least see 14,008 to 15,002 conservatively. My initial target was 16,000 even. We have now already done a correction. Okay. So again, like I say, the Invesco QQQ Trust ETF, it will mirror the movement of the NASDAQ index.
Right.
Okay? So you see, ETFs are very unique. They allow us to even participate in the action of the index, whether it's tech or normal index.
So between choosing an ETF and another asset class, you would, how would you, what's your ratio in a basket?
Good question. You see, we buy an ETF for diversification, and because the cost is low, and most importantly, the volatility in an ETF is lower than an actual stock.
So you're actually hedging your risks.
Yes, but ETFs are good for that. But if you know something about a specific company like Microsoft, of course, I would do both things. I would buy a technology ETF, okay? I would, for example, I'm giving you my brain for free now, for preview. So if I want to do an ETF, okay. So if I want to do an ETF portfolio for you, I would first of all buy a technology ETF for you to allow you to have a finger in all the ETF sector, the entire ETF sector. And then I would also buy specific technology stocks. So you got the best of both worlds. You got the you got the macro of the entire sector, your finger there, and then you got the micro into individual companies. So can you see what I'm doing?
So how much does it cost us to start an account with you, portfolio with you? What kind of committed capital?
I will tell you, the capital is 5,000 US a year. And
that's
let me stress,
that's your fee.
That's the fee.
I'm asking you about how much committed capital should I put aside to trade with?
Okay, between 50 and 100,000 US, and the cap is 100,000.
And where does this money go? In your account, my account?
This money will be lying in your account in a broking house.
In my account in a broking house.
Yeah, I will have no control over your money. But what we will do for you, we will hold your hand, we will do things for you, tell you what to buy, what to sell, and even execute the order for you. But the money is in your name, in your account.
And all the time you'll be explaining to me what you're doing and why.
You see, when you're sleeping sometimes at night, you know, Tessie, you go to bed at 9 o'clock, 10 o'clock, 11 o'clock.
But this is US market, right?
Yeah.
US market action is when I'm asleep.
In the US market, things come alive after 2 a.m. every night. So this is where we are awake. If you give us the power of attorney to do things for you in your account, we can capture the best deals for you after 2 a.m. And usually the best time to trade for me is half an hour before market close at 3:30 in the morning, at 3:30 in the afternoon, New York time. Because before closing, I'll tell you why. Before closing, all the day traders get out and we want to take structural positions. So we buy things cheap at 3:30 a.m. So at that time,
I want my beauty sleep.
So this is the reason why we get a power attorney from you and we do things for you. For your own good. Because you will literally make money while you sleep. Now let me talk to you about the ETF market, okay? JP Morgan has introduced a climate change solutions ETF. Can you see how amazing this is? Like I said, ETFs have got different portfolio baskets. They've got a basket of climate change solution companies, okay? And there's also an ultra short income ETF, which has become the largest actively managed ETF in the US, okay? With more than 18.4 billion in assets. Can you see?
It's not really only for sophisticated investors. This is like taking over.
But there's one catch. There's one catch. You must know which sector is going to be in demand the next. You must know the action, the flows. This is where we come in, because I'm not being boastful here, but this is where
Yeah,
the
no,
normal man, this is where the normal, normal investor will
yeah,
not understand the flows.
this is
We understand the
expertise
flows.
in every level.
Yes.
Yeah,
So that's what
when
I'm
we
saying.
need something.
If you want to make money, you have to pay us for the expertise.
Yeah, yeah, bank with the best, I always
Yes.
say.
Yes. Now, as ETF surge in demand, what we've been seeing, like in Malaysia, Malaysia is a very mutual fund kind of market. They believe in mutual funds. Now, mutual funds are on the way out. Now, like I said, as ETF surge in demand, mutual funds, and please, Malaysians, please, fund managers, please take note of this. Mutual funds have started to lose their appeal, especially
you see,
outside.
Ashwin, you trade US and Europe and Hong Kong, but local people who haven't been exposed, we trade Singapore and Malaysia at best. So we've only been exposed to mutual funds, and mutual funds have a good deal in that they take very small startup committed capital. So
but I must say something, Jesse. I must say something. You see, you pay peanuts, you get monkeys already. Because if you talk about Singapore and Malaysia only, where is the performance of Singapore and Malaysia over the last 2 years? The big performance in the last 2 years have been global.
Let's say if an investor has 50,000 ringgit Malaysia, and they put it in a mutual fund. I mean, at least it's there, and it's someplace that they can see. But you have to consider the yields. You have to consider inflation. You have to consider the value of the ringgit.
Now, from what I understand, Malaysian mutual funds not more than 5% a year.
Yeah, and
they're giving you 20 to 30% a year.
And in US dollars.
Yes, not ringgit. Huh? Mutual funds pay you 2 to 5% a year, or maybe 6% even.
So I
are paying you 20 to 30% ROI in US dollars.
I would say put aside 100,000 US dollars, which is not a lot of money, and get 20 to 30% yields.
Yes. Yes.
As opposed to putting it in a mutual fund.
Because mutual funds are on the way out.
Depreciating asset like ringgit.
Yes. You see, mutual funds are on the way out. I just said that, right? Because it's no more in flavor. Now, this is very important. The ETF action now has arrived, listen to this, in Singapore. Because Singapore Exchange knows that mutual funds are on the way out. The Singapore-listed iShares Barclays USD Asia High Yield Bond ETF, everyone listen to this, it attracted 1.37 billion of net inflows in the last 3 months of 2021, means September, October, November, December last year. Singapore understands and knows, especially now because the SGX head is Loh Boon Chye, ex-Bank America, ex-Deutsche. He's a genius. And they have been doing new things. Today, Singapore has got a SPAC. Okay, that's another instrument, like an offshore listed vehicle for companies like Grab, who use SPAC to list in the US instead of IPO. Singapore has now got SPACs. Singapore has got SPACs. Singapore has now got ETF. So please, Malaysia, you have to wake up and, up your game. So now Singapore has got an ETF already. It's got a bond ETF already. And one of the most exciting things I must tell you as a hedge in ETFs is bond. You see, before bond ETFs arrive, we have to buy individual bonds, check the exposure, check the dates, everything. Now we just hedge by buying a bond ETF. A bond ETF is a basket of bonds. So if bad news comes out, okay, bonds start going up, your ETF will go up in value. Of course, now because of the Fed increasing interest rates, expected to increase interest rates 5 to 6 times, all the bond ETFs have come down. Okay, but I'm just saying in a normal scenario, it is a very interesting hedge to buy a bond ETF. That's why
I think what you're saying is very good for those of us who want to migrate away from like the housewifey kind of investing, mutual fund and bonds, and now to something a little bit more sophisticated, ETFs, and what the Singapore people are doing. Yes.
Now you can see something, Tessie, like I said, like you said, the mom and pop style, the housewife mentality.
Yeah.
Now, again, I say this, not with maliciousness, but with sympathy. These are the housewives types that always end up cutting loss. This is one of the main inspirations I had when I said, I will not charge them performance fee, only $5,000 in fees for a year. And I will help these mom types, pop types, these housewife types to make good money. It's very sad.
But only those who want to learn to take back control over their financial decision making and, being financial security, their own financial security, rather than just those who just follow the trends and then end up in the ditch.
Last Monday, when I heard this news about 1.36 billion US dollars being cut loss, I was very sad because as usual, the banks never end up losing money. They know how to hedge, they have the sophistication, they have the money, everything. But these
I know, I used to bank with banks and I didn't get the kind of in-depth research and banter that we have now where
so what I'm
I'm learning so much.
What I'm sad is 1.36 billion US dollars of hard-earned blood, sweat, and tears money went down the tubes.
I think any intelligent woman, as I'm speaking for all women, I think any intelligent woman would want to embark on a program with you, and certainly people with a lot more money who want to really put their foot in the right spots. Please contact Ashwin.
Please understand this. Like I say, we want to help everyone, but it comes to a point where we can't say we help you at no cost.
No. That's a minute detail because it's so cheap. $5,000.
Yes.
That's your only exposure.
I can assure viewers one thing. By 12 months, you definitely cover back your 5,000 US.
5 months. This is a long time.
No, 12 months, I'm saying. 12.
That's too long. I did mine in a few months.
That's correct. You took 3 months.
Yeah.
3 months, we covered your 5,000.
Yeah.
Okay.
And I was playing so small too.
So we would like to help every one of you. And I brought the story up because I didn't mean it as a show-off thing. I saw it with very much compassion and sadness because, like I said, 1.36 billion US dollars of hard-earned money.
No, I think you're absolutely right. We need to smarten up. We need to wisen up because things are shifting. We need to be a part of that shift. Shift to quality.
Yes.
Quality even here.
For example, let me tell you now.
Decision making, quality in expectations of higher, more crisp yields, and not just wondering what's going to happen to my money. Like I don't know, I'm not in control of anything.
Now let me bring the most important point of this video before I sign off. Already the Fed has signaled that they will have the first rate hike in March, and the market is pricing at least 5 rate hikes. Listen, everyone. Market is pricing in 5 interest rate hikes of 0.25% each time in 2022.
Wow.
Okay. So interest rates are definitely going up. So what happens? Why is the stock market coming down? Because the market's worried about these interest rate hikes. But like we have been saying in our video, when interest rates go up, we switch back to the balance sheet mode. Meaning you buy companies that have low or no debt, good pipeline of goods and services that are doing very well. And we go back to the balance sheet mode because what distinguishes a company from one company for another? The earnings. And a very good example this week was Microsoft. I must tell you this. So Microsoft came out with earnings this week. On Wednesday, after market close, Microsoft, I'm telling a true story now, everyone. We have been buying Microsoft from 280 to 320 for our clients per share. Okay, so on Wednesday, Microsoft earnings reported. What happened was this. Usually Microsoft Azure cloud earnings, they are about 50 to 55%. This time, the earnings for cloud dropped to 46%. So as usual, the market is disappointed. Oh, it was not above 50. It was only 46, below 50. So let's push the bloody market down. So Microsoft share dropped from 298 to a low of 277. I'm telling you a real life scenario here. So I woke up at 5:30 in the morning and my algo alerted me, Microsoft is now trading at 277, 278. I said, what? What's wrong? Why is it trading like this, $20 down? So because market expected 50% for cloud earnings and cloud earnings were only 46%. I started smiling. I called my banker at that time, and we execute orders for our clients. We started buying at 277, 278. We started buying. That was at 5:30 in the morning. And we couldn't get enough because we want to buy some more, and the price was running away. At 7 a.m. in the morning, that will be Thursday morning. Microsoft reported at 5:30 a.m. Actually Thursday morning, New York time. New York time was 5:30 p.m. Okay, but our Asia is like Thursday morning, 5:30 a.m. At 7 a.m. in the morning on Thursday, Microsoft share surged from 277 to 298. So instantly our clients made about $21.
Amazing.
In 2 hours. Now, what made us, again, this is a live proof, what made us so sure-footed? Our algo. Our algo at 5:30 in the morning said 277 is rubbish. To our algorithm, Microsoft below 280 is ridiculously cheap. I use the word ridiculously cheap.
Yeah.
Okay, and Microsoft, just for information, despite all this volatility and fear and interest rate hikes, Microsoft ended the week above 300. Can you see? So this is why I say, when you buy quality, what is the fear? When you buy quality, the proof of a company's performance is the balance sheet. I'm sorry to say this, everyone, screw the index. Screw the index. If I'm buying Microsoft, if I'm buying a quality company, I don't care where the index is, because I'm concerned what are Microsoft's earnings going to be 3 months from now. And as long as you focus there and don't fear and don't panic, you will not lose money. This is what I've been trying to say in my videos all this while.
That's
when you buy
have
a quality company, you don't need the index. You don't care about the index.
That's when you have expertise behind you.
Yes. So now let me give you a free tip. Everyone, this video, okay, for 2022. Get into ETFs. Get into sectors-based specific ETFs. And a free tip for you. Microsoft will go to $400 per share in 12 to 15 months' time. This is a free tip for you. When it happens, I will tell you in your face, I told you so.
Thank you so much for
this
today.
Is why, now do you understand why we are buying Microsoft at 277, 280, 290, whatever?
Yeah.
Please, let us help you. Allow us to help you. But we
How do we contact
charity.
you, Ashwin?
My email is ashwin@ppchk.net. On WhatsApp, it's bit.ly/algotrader on WhatsApp. bit.ly/algotrader. On Telegram, it's bit.ly/algofactory. And you can watch this video at bit.ly/algowealth on YouTube.
Thank you so much. We'll see you again soon.
I hope we have been of tremendous inspiration to you.
Thank you.
In this first series of 2022. Kongsi Fashai, happy year of the tiger.
Prosperity, abundance.
May the force of wealth and the water tiger be with you this year.